Hey, folks. Good morning. Good morning. Good morning. I apologize in advance that I am on the road this morning, so it may not be as smooth as I'd like, but we will do this. It is an incredibly important day, just because there's a lot of results out, a bunch of developments on the M&A front, on the IPO front. And then we really need to discuss further the Federal Reserve's rate decision and the comments from Kevin Warsh yesterday. I'll start off before we jump into what I think will be the majority of the time, talking about Warsh yields, Microsoft earnings, Meta earnings. Let me go ahead and eat up a little bit of time with some other stuff. Um, s- what wasn't good is good again, right? And I think we've heard that out of the Starbucks turnaround is working. Chipotle doing well once again. Um, we've got everything in the software space had a great day yesterday. Salesforce, Datadog, Garmin, Intuit, Workday, Adobe. If you believe in those stocks, the next question to ask is, well, then certainly you should believe in the private credit folks who lend to all of those software stock companies. So I think there's a quandary there that you have to resolve if you are long those software stocks. Certainly, all software stocks aren't created equal. That being said, the answer can't just be that kind of blanket answer. There needs to be more resolution between the gainers and then what's going on still in private credit. Um, Jersey Mike's, yes, the subway chain from New Jersey has priced its IPO, an outstanding LBO end to end by Blackstone. Um, we had news out that OpenAI's rogue agent breached a second AI firm after Hugging Face. That is Modal Labs. Um, and the biggest loser yesterday was Lennox International, which is home furnishings, homeware, houseware, and just came up with poor earnings in comparison to expectations. And this is important, Adidas. Stock is down 17%, even though it was thought to be the winner out of the wars in the World Cup, having been the sponsor of the two finalists in the World Cup. But they reported lower than expected earnings and higher marketing costs relating to the World Cup. In the World Cup news, as Eric discussed yesterday, the calls for no sale of FIFA are getting louder. There are emergency meetings going on. UEFA is holding emergency meetings to somehow try to block this. I don't know if legally anything can be done. It's a little bit of it's interesting that it comes at the same time as we've now found out that Live Golf is effectively going to fold, which is a competitive tour to the PGA that was started with Saudi-backed capital, and we were told the Saudis were out of supporting Live, and Live has now canceled its last event of the season. Seemingly, it is going to go into some form of liquidation. Dwayne I would love to get to you first, if you don't mind. If you can talk to us about this potential sale of De Beers at roughly $1 billion. What kind of degradation, diminution, destruction of value has happened to De Beers and the natural diamond industry versus lab grown diamonds that are just getting better and cheaper. And where does this all go for diamonds? Period.
Well, hey, good morning, everybody. It's good to be to be here this morning once again. So yes, well, with De Beers, it's we can talk about the you know, beleaguered De Beers here. It's really a tale of a company, and just to put this into put this into a bigger perspective, right? Here's a company that's been around for 100 plus years, and they really cornered the market in regards to natural diamonds, just basically controlling 90% of the market. Really just controlling and forcing the price, basically saying, okay, here's our dealers, here's Russia, here's other countries, and saying, well, this is our price, and if you don't want to take it, then we're going to knock you off of our you know, basically knock you off of our preferred buyers, which is basically a death knell for anyone. So it's very interesting to see now over the last decade what's happened with them. So they've gone from say revenue of say around $6 billion, $6.1 billion, all the way down to say about 3.5 now. So nearly cut in half over the last decade here, and it's really yes, a measure of these naturally grown diamonds, which have continued to basically eat up the market, right? So, we can see over the last couple of years here that De Beers responded to this how they have over the last 100 years by creating their own company, basically. I think it was called Lightbox, where they were selling natural diamonds. And this was their attempt to flood the market with natural diamonds and bring down the price so that they could get higher prices for their natural diamonds versus the basically versus the artificial diamonds. But that hasn't worked out that well also, right? So it's just interesting to look at what's happened here, because now the company is being sold, as you were saying, for less than a billion, around $1 billion. So we can see the real damage here that's happened, right? Because the newer generations aren't really putting a price or a value on diamonds the way that the older generation has. So even the campaign "Diamonds Are Forever," as everyone is familiar with, that was really a campaign to stop the resale of diamonds. So they're trying to. So the whole idea was to create a marketing campaign, or the adage, or the idea that a diamond is a family heirloom that you hold on to forever, so that they could make some more sales. So it's just interesting to see what's happening with the diamond market. When we look at this from a bird's eye view, we can tell that natural diamonds are basically going to rule the day here, and even the selling pool of diamonds for De Beers has really dwindled in of itself, right? It's basically a few retailers now, and a few families which are still involved in the diamond market. So there is a market for natural diamonds, but it's dwindling over time. Not to mention all of the problems we've had with supply chains over the last couple of years here, with war and conflict, plus the inflationary fears around the world. So a diamond is basically the last place that people are trying to invest now, right? So people are going into moissanite and some other precious gems for marriages, engagements, etc. So, just some thoughts about De Beers in general. And I've been keeping up with this, as you guys have been keeping up with this as well. But it's just an interesting story overall, really, to put a close on it, of science and technology catching up with just some of our desires in human nature, and the way that companies market to us. So if you're a skeptical person, you would say that this is, I guess, just desserts for De Beers after after all of these years. But if you're someone who values and looks at diamonds, this is basically the fall of a very solid 100-year company just from the forces of technology. But I'll stop right here. Those are just some thoughts. Back to you guys.
No, thanks, Dwayne. I just want to know the bid. So it's going to be sold for about $1 billion. The bid by BHP 2.5 years ago for $50 billion. That's $49 billion more than the current rumored price was, and it was rebuffed. Was that this? Was it an apples to apples offer? In other words, it really has gone down $49 billion in value over 2.5 years.
Well, at least to my understanding, the $50 billion buy was really what was really an attempted takeover. So I mean, this is just me speculating, but I would imagine they were making a good offer here in order to basically break down the company for basically for its parts. But I really but I really don't know, right? Because looking at it going to 1 billion here, it's really like almost a 90% valuation, a 90% valuation decrease. So I think it's really them understanding now what's happening with the market. So I think they were looking at the history of De Beers and looking at the value of natural diamonds, because there's still a lot of like we were saying, there's still a lot of value with sellers. But I think now, they're realizing that they have to take a different direction, despite the fact that their new direction over 5 years with artificial diamonds didn't really work out. So, this is probably, if not the end of the story, we're going to see a much more diminished diamond market overall, especially amplified by De Beers.
It's amazing. It's really breathtaking. All right. Thank you for all of that, Dwayne. Let's get into markets from yesterday and then rolling into today, inclusive of earnings. So the Dow had its worst day yesterday since April of 2025. We were having a bad day up until Kevin Warsh started to speak. Kevin Warsh spoke. The markets rallied all around. As soon as he stopped speaking, it all went straight back and then further down throughout the afternoon. It was a pretty bloody day in the markets. And like I said, we had some very important earnings reported after the close yesterday that we will talk about. Andy Kaufman, I know you were with us yesterday afternoon, and I thank you for that very much. I'm hoping that you can give us a bit of a summary and maybe some additional thoughts that you've had since we spoke yesterday afternoon.
Yeah, quick summary. Good morning, everyone. Good to be here. Quick summary is they left rates unchanged. He came out and said that he is, and the rest of FOMC is going to hold this 2% target, not 2.1, not 2.3, and they're going to get it there. And that he came out as hawkish as he could, but at the same nothing. And he laid out some framework in terms of how he is going to think about running the Fed. He laid out the framework and questions that he wanted to think about in terms of how he was going to do research into what to do in terms to get this inflation story intact. And he made it clear that this has been a 5-year problem. And he said he's not watching data, he's watching data trends. And I think that's the big takeaway. That's the summary. The big takeaway is, I think until I'm proven differently, I believe we've got a dove in hawk's clothing. And I really believe that, his commentary came out extremely strong, that he believed in getting and taming inflation, and yet he didn't do anything. So it feels like he's taking his time and trying to kind of reestablish and remake the Fed. The issue is the markets and inflation in the world. doesn't have time. We operate in real time, and he didn't inherit a new business that he's building from the ground up. He inherited a 100-year-old institution, and I think this was a miscalculation in terms of either his actions and his words, but they weren't congruent. And I think the market sold off in the curve steepened, as you would expect with the last I would say, and it was brought up by someone on the call, is that there were 3 dissents, but one of the dissents was not Powell. So that's interesting that part of the Fed seems to be aligned in operating at least to the outside world congruently and in a way that's at least collegial from that standpoint. So it seems like there is some harmony, at least in terms of the operations, that, hey, he's allowing people to have voices. He's allowing them to dissent. He even said in the press conference that he wouldn't speak for other dissenters at the Fed, that he would let them speak for themselves, privately and publicly. So I think he's allowing that to happen, but it still feels like his voice is the voice that's going to determine how things are going to move going forward, and that it's not necessarily going to be a vote here, or Powell going to swing things, or the old faction. So, time will tell what actually happens at the next meeting. But the other thing that was very interesting is that with the rate move, at the beginning of the meeting, before the meeting, we were close to 80% probability that there was going to be a hike in September. Once he stepped off stage, it went to 58%, and it might be closer to 54% this morning. So the fact that we went from a near certainty that there was going to be a rate raise to a coin flip at next meeting, I think is very interesting. That I think the market is interpreting exactly what I am, that this guy might just be talk and no action, but time will tell. Back to you, Dave.
Excellent. Really great summary, folks. If you didn't hear us yesterday, 2 things. I urge you, to listen to Warsh on recording, and you can listen to our commentary thereafter. I posted the space. In terms of listening to Warsh's commentary, there may be not very many more times that we hear him at length. He committed to speaking throughout the remainder of 2026, but gave no commitments beyond that. Jackson Hole at the end of August could be just an incredible, I don't know what Warsh will want to believe is an opus or masterpiece. Andy Kaufman's frustration, I think, is well founded. One thing that we all can agree on, I think, is that I keep saying Powell. Warsh is an exceptional showman. Exceptional. I think he presents incredibly well, speaks very well, doesn't lose anything. He knows how to ingratiate himself with his audience. But all of that being said, and he performed a very good sleight of hand, that when people were asking about inflation, he did not respond on the inflation point. He spoke further about the fact that the market is going to do the job for him. Rates are rising, real rates are rising in the market, as we have the 30-year above 5.2%. And so he can continue to just go ahead and talk and do nothing and talk less over time. And he's going to hope and pray that this all works out well without him having to do very much. It was a spirited discussion yesterday. He also believes that there was a spirited discussion inside of the Fed, a family fight, as he couched it. And he saw strong growth in business investment, obviously alluding to all the AI related spend. But he certainly said, in no uncertain terms, that 2% inflation target is what it is. He is focused on that. That's where I think Andy is getting most frustrated. He spent a lot of time enforcing the fact that 2% inflation is 2% inflation. We will not move the goalposts in any way, shape, or form. However, he's not seeming to do anything to get to that any quicker. And his best answer to a reporter that asked about, why isn't he moving, was you have to be patient. And patient, unfortunately, you could keep saying that forever to somebody, especially if you believe that the market is going to do the work for you. Those are my additional thoughts. But Andy, phenomenal job. Thank you for summarizing it. Eladio, go ahead, and then we'll go to Eric.
Yeah, that is a problem because when you set a strategic goal that is intermediate to long term, and obviously we have the Iranian war, but you have a strategic goal to bring inflation down to 2%, and we're in the middle of two regional wars in this world. We're also obviously in a situation where the price of oil is not going to help the Fed's cause in any way to get to 2%. So really, the actions of this Fed don't show at least that they're ready to make that move, and that right now they're more worried about the stability of the economic situation in the United States and the markets still. Because otherwise, I kind of have to agree with Andy. If they really want to get to that 2% inflation, unless they want to do it at such a slow pace that they're not going to disrupt the markets, I guess that's the conundrum. Are they going to be able to do that? They should have raised rates if their intention is to get to 2%.
Thank you, Eladio. Go ahead, Eric.
Definitely agree with both Andy and Eladio. And that's the thing. What I perceived when I listened to Warsh is that he's been selected for the role as a speaker, as somebody coming from the probably intelligence community as well. On that side, they're all linked now. That's that much of importance of effect that he has on the economy. And I think he's just taking people for a ride when he's insisting so much on the 2%, which is absolutely impossible, especially because he talks about everything as if the Fed could drive the inflation to 2%. And this is what the biggest con is. But he can't, because it's the Treasury which will print forever and force the inflation to be higher than 2%, which means to get to his 2%, he will cook the numbers further. So is there really doing the job of a salesman and a con salesman to try and keep things going in the United States, to try and keep the ability of the Treasury to print and print while people still believe in that the Fed will be able to control inflation, still believe in the system, still kick the can down the road, rather than making big reforms both in government and the Fed. And so to me, this is probably the reason why he was chosen, and he's going to be less less interactive in the future, possibly, probably, than Jay Powell, which lets him even be less honest to the people. Maybe not less honest, but when you hide more, when you say less, so you kind of can do more shenanigans in the background. And this, I think, is particularly hurtful because the way he spoke when he said that he's going to have task forces which are competent, he's going to get new data, more accurate data. That's all very good things that you need to do, which I would commend him for, if it was all really for that purpose and that he's really going to try to tame inflation. But it doesn't seem to me that way. It seems to me like a good speaker who's there just to sell something, to keep the system going. And the day that I hear him, just like one thing I will credit Jay Powell. He kept saying at every time we went to Congress that you guys need to get your act together. Your spending cannot continue that way. Jay Powell kept saying that. And we'll see if Andy Warsh actually does. He might, you could say from one perspective that, well, Powell and Andy Warsh will say that, but they don't enforce more. They don't have the legal authority. True. The authority lies with Congress and the president. And I think this is where, for inflation, this is nowadays definitely where the most is. Like Eladio said, if you wanted to tackle really inflation and bring it to 2% now, not only he would do interest rate rise, but he would also do quantitative tightening, and that would collapse the economy. So he has very little room for maneuvering, and it's going to be more of a job of a salesman to keep the system going, and then to use, while Besant wants to go and use these stable coins to continue the system going, as Carlo pointed out. And this is where we are at. Back to you, David, or to David Nikoski. I think David Nikoski has a hand up.
Yeah, I do. Well, just from the market movement observation, when you looked at the short end of the curve, those got beds, and the long end, the yield shot up and sold off. So, you know, I take this as he's going to, push for a higher, or, he wants higher rates, but he's going to do it through inaction. So the economy's stronger, inflation's going to stay hotter than 2%. And the bond market was telling you that the equity markets were responding to the bond market. Um, I have, I'm watching the gold continuous contract, which is it just inflected yesterday. It was interesting, even as the long bond yields moved higher, the dollar did not. And that's something to keep in mind. I've been uh, in the camp that I don't think the dollar, is going to sustain the most recent move above the 100 level, 101 level. So it'll be interesting. Dollar is down at 133 right now, even with the higher yields on the long end. So, um, if you look at the markets globally, everything that is, all of the indexes that are associated with tech have been, much weaker, and showing topping patterns. So that definitely has me concerned. Korea, was up early in the when it opened. It actually closed negative. Japan was up. You look at something like the Kosdaq, which is the Korean technology names only. I mean, that thing has been absolutely torn apart. So, my concern would be still, that we're seeing, a massive rotation. If the dollar continues to weaken and it breaks through that 100 level, my thoughts are that you're going to start to see repatriation if the dollar comes down out of the U.S. markets. That's what brought Korea down. You saw foreign investments absolutely be sold off by foreigners, and foreign holders of the Kospi. Um, on another note, you saw Meta's earnings and Microsoft. I'm going to kind of jump the gun before it's brought up, but Meta has been in a relative strength downtrend. It has been far underperforming the market to the tune of, close to 40% from its high. It's not leadership. It hasn't been leadership. I haven't got a hole in one on a par four. I don't try to pick, bottoms of charts that have high trading ranges where, you get 20% rallies and they fizzle, but the downtrend's still intact. It's just, not my cup of tea for my clients. Microsoft is in that camp. It's also down in excess of 36% from its high. The market is nowhere close to that. So you can certainly pick a name that gets a 10% rally until it reverses. For me, the relative strength downtrend. It's done this plenty of times throughout the last year. By the way, this is not the first time. So it's not a stock I'm interested in. I will go for the better probability names that are out there in the universe that I'm finding. I
Sorry about that, Dave. My apologies. I'll just
No, that's
I'm
fine.
I'm on the road. Go
No,
ahead.
that's fine. It's understood. So I just don't try to attempt to pick the actual bottom. I need trend lines, and when you have these you know um, wide trading ranges. Meta rallied right to its relative strength downtrend before it reported, and you see the results of it. It's interesting. Microsoft, stated I think it was 170 billion in capex, did 41 billion in the fourth quarter. If you counted for inflation in the tech arena for what pricing has been doing, if that continues to hold, I see that as a marginal cut in capex relative to the inflation you're seeing there. So while it's not a cut in absolute number relative to the inflation you're seeing there, it's a cut in my opinion. I think you have at least 15 to 25% inflation in that area from a year ago. So if you were looking at an apples to apples basis, you're actually getting less product for that dollar amount, even if it's a raise. So that's my interpretation of looking at the numbers. They did have, quite a bit of increase in, investments in there as well. So as good as the number looked, as great as, their web services was, which was a great number. I think that, looking through the numbers for me, and again, I was an internal auditor for many years. The numbers don't number for me. The math doesn't math. So that's my opinion. Back to you.
Yeah, no, the excellent points. On Meta, the company laid off a couple thousand people during the quarter, about 8,000 jobs in May. It had a severance cost of north of $1 billion. R&D jumped by 67%, and it has raised the low end of its 2026 capex for the year. And so I think there's a lot of challenge here in terms of being faithful to Meta, as we saw with Google, which their free cash flow went negative. Meta, not negative, but nevertheless, scant amount of free cash flow. It's spending, everything. Its free cash flow, just to give you a sense, on Meta went from 8.5 billion to 784 million on a year-over-year basis. So the spending is what is concerning, and you've got to get two things. First of all, you've got to recoup that money, and second of all, you're hoping as a shareholder that you're going to make a very nice return on that capital. So for right now, when it comes to the hyperscalers, at least as of today, the jury is out. The market, rightfully so, is much happier with Microsoft, which is a lot less of a capital, at least at this point, a lot less of a capital intensive business, has been able to keep up its operating margins. Meta, for instance, its operating margins went from 43% down to 31%. So, it is very difficult as an investor to have the same level of conviction because of all the risks associated with Meta's outsized spending, Google's outsized spending as well. Eladio, any thoughts on any of that, tech heavy selling and what, the needle in the haystack might be, or the diamond in the rough here?
Well, I mean, it's just free cash flow has just been a great indicator for how much deterioration the stock price is going to have based off of this increased spend. What we did see, and it seems to be, is that we are seeing definitely a deceleration, because in the case of Facebook, all they did was lower their lower end number. If you notice, they didn't exactly raise that $135 billion number much or at all. So again, it adds credence to what I had been saying a few months earlier, that what we're going to see is a sizable pullback in this market, not even from a decreasing of that data spend, but a deceleration of the rate of increase is where you're going to get that damage, because the damage is always worse at the beginning of a pivot of something that is changing directionally. So again, watching free cash flow in the next few months is probably going to be a good determinant. I decided I after holding Meta for 12 years to get rid of it at the end of last year, January, and into February. And sometimes you get lucky, but again, I had outsized returns, and I was seeing that Meta's deterioration was actually the worst of the top tier companies of the Mag 7. And the one that has the worst deterioration of it isn't a Mag 7 stock, but it is Oracle. Oracle's stock price pretty much shows the evaporation of their free cash flow and operating, and their operating cash flow. So that's what I'm going to keep my eyes on. I believe hardware is over. It's as a trade. The AI trade in hardware is pretty much, in my opinion, over. I feel there's just too much value in other places. And I still think historically, the Mag 7 or the FANG, whatever you want to call that group of tech stocks that's leading the whole market, has always done well in the environment that we're in now, with one exception. And it is that the Fed is going to not lower rates at any point this year, unless there's a black swan event. And that doesn't bode well for the concerns of crypto or any risk asset that is looking for a debasement of the dollar and more liquidity in the market. And so it is difficult to square, like Andy said, the idea that you're going to have a 2% inflation target, yet that the Fed is basically going to not do anything here at this point. I think that the probability of a rate hike now is much, much, much higher this year because of the fact that the economy is not going to slow down. There's a lot of money from the big beautiful bill that's coming into the economy that's being injected on purpose, especially before in an election year. And it's just going to be hard for the Fed to lower rates. So I don't see that possibly happening if they want to ever get close to 2% inflation. So right now, I am staying away from all semiconductors. I'm just not interested. It's just that's the area that went parabolic, and I think all those stocks are probably going to go back to the levels that they were before the March bottom when we had the beginning of that month-long ceasefire. And I think it's a stock picker's market. David Nacosta has been very good about giving us a lot of sectors that look interesting. There's still a lot of value in a lot of areas that are sectors that would do well in this environment. In healthcare, I think industrials, in the case of Caterpillar, it is the premier name in the industrial space. It's giving back some of its AI premium. Let's leave it at that, because as you know, when you construct a data center, it doesn't just come up on its own. You have to basically construct them, and Caterpillar's benefited definitely from this AI capex. But now everything is in question, and I think the markets might be choppy into September. And then if rates do go up, I mean, the market might be pricing that now. So there are my 2 cents.
Those are very valuable 2 cents. Dave, before I get to your hand, need to point out a couple of things, which is Microsoft's quarterly earnings includes about a $3+ billion gain from its stake that it holds in Anthropic. On the point of Anthropic, and on Eladio's point about chips being very much out of favor now, Leopold Aschenbrenner, I don't know if folks know who that is. Boy wonder, yes, Brandon. He runs a fund called Situational Awareness. He's made an incredible amount of money in a very, very short period of time. He is an ex-OpenAI employee that rolled into the investment business and made he's 25 years old, has made an incredible amount of money, managing north of 20 billion now. Apparently, report out from the Financial Times, but there was already rumor on X that he has serious margin calls relating to his portfolio. He made a crazy amount of money on the entire AI trade over the first half of the year. And now that is all coming crashing down. And if your margin, as people in South Korea are very well aware of now, your margin calls can kill you, put you out of business. And so there is potentially, some ripple effects going on in the fund world surrounding the sell-off that we're seeing. I don't hear a loud cry about it yet, but nevertheless, at the very least, some of the highest of flyers like Leopold are coming back down to earth on the basis of this trade. And yes, there are an incredible amount, volume wise, of accounts in South Korea that are being liquidated because of the pummeling that is happening. With leverage, as we all know, selling begets selling. And frankly, you're not in control at a certain point. And the prime brokers go ahead and take over your book, and they're going to sell at any price, further driving the price down, especially if there's no bid in the market. David Nikoski, to you.
Yeah, a lot of you talked about the data centers, and when you look at the names, I was extremely early on the engineering and construction firms turned bullish in, June, July of 22 in the midst of a bear market. Sterling, MCore, Caterpillar. I mean, they're all breaking long-term uptrends. So it tells me, the market's convinced that the data center build out is slowing. It's not gaining traction. Stocks were priced for perfection anyhow, but you see that unraveling. So I would agree with everything that Eladio said. I think you can get a lot of bear market type rallies in a lot of these names. Many of them are parabolically extended down. Even when it comes to the chips. So I wouldn't rule out, with future strong today, people wanting to go in and bottom fish them, for the long term charts that I'm pulling up. You look at the S&P, see a rounding top, you see what's leading right now, and it's not in the areas that everyone loves. Someone tried to corner me and said, "Oh, so you think the AI trade is over? Why don't you say it?" There's going to be individual stocks that work, and you can point to one and say, "See, it's still working." But I think it's few and far between. I'm not going to be the hero to pick them. I'll just wait until the smoke clears, and see. Look what the battlefield looks like as it's evolving, and take shots at some things. But you look at CoreWeave, looks absolutely like a disaster. I think it was Nvidia is trying to do a $250 billion placement of funds for a buyer of GPUs. You have to question the circular financing, and if you don't, it's been talked about for 6 months, but when it hits at the right time, you create the inflections on the charts. Going back over the last 6 months, clearly if you were a bear, you'll be right at some point in time. Timing is everything, and it's the only thing. And you can sit there and be wrong for 4 months and then be right and say, "See, I called it." Yeah, but you missed out a 40-50% rally in some of these names. It comes down to timing. And I've been in tech is an overweight. And, I still see that you can be overweight tech, but it's in the software arena now. All of the AI that was going to replace, Adobe's gone from 190 to 263. Burry's been all over it. Like, as much as you may dislike Burry, he's not day trading. He's buying things, and he was buying on the way down and certainly lost money for a month and a half, 2 months. But the guy has been absolutely on fire. And but he gets called out. When you're in a public profile, you get called out. If you were Joe Blow investor, posting on your timeline, you're going to get some criticism, but it's not going to make headline news. So take it for what it is. But there's certainly a great degree of rotation happening underneath the market. That I went on a number of spaces yesterday, and they're like, "Oh, these tech stocks are, TTMI has gone from 230 to 105. I think it's going to make a bottom. I really liked it at 230 though." Like, it's incessant. I hate to say it for you Bitcoiners in there. It's like listening to the last 6 months of Bitcoin. Oh, this is it. This is not the bottom. So just let things settle. The volatility in individual names is enormous. And the algos can certainly trade faster than most, than your average trader out there. And so be careful out there. Back to you.
Thanks, Dave. While we've been chatting, GDP for the second quarter came out. It was cool, only 1.5% growth rate. And June core inflation came in at 3.3%. The GDP, just so you know, the projection was for 1.8. Again, we came in at 1.5, and the PCE was expected to go up 3.7 year over year, and came in at 3.3 on the core basis. So not as hot as expected. Maybe Kevin Warsh is putting his hand up for some high fives. I'm not really sure today in the wake of his speech. I will get to Honest in a minute. Let me get to Eladio, and then Brandon. I wanted to see if you had anything to say about Leopold, Anthropic, so on. So go ahead, Eladio.
So this is one important point, and I don't think enough people talk about this. And even though machines are in charge of what I call these flows in many ways, institutional machines, there's a psychological, logical part of investing that I find many people don't use, and it is incredibly, very, very valuable in actually predicting future moves. And the fact is, it's a Pavlov's dog syndrome. You learn to buy the dip and to buy the dip and to buy the dip. We've been actually conditioned into buying the dip because the Fed is going to come in and save the day, and has since 2009. And we've been conditioned to literally blindly buy only on the amplitude of the stock, forget even the fundamentals. But when you look at the psychology of losing half your money in 1 month, there aren't examples of losing half of your money in a whole sector in 1 month. And then, in order to recover back to where we were, you'd have to actually recover 100%. You're down 50%, you have to recover 100%. The psychological damage of the fear of losing more money is going to automatically make every rally in the sector that is the center of the storm, and in this case it is hardware in this order. I would never touch optical networkers at all because I was there when the global crossings of the world, you remember those days, David Nakoski or David
Yeah, I
Powell?
remember JDSU. We covered it at the firm I worked at the time, and
AAOI, all those.
yeah,
They're all parabolic traps. They're always, like I always say, commodities always rally at the very end of something. Well, the same thing goes with these optical networkers. And then you go to the OEMs, the original equipment manufacturers like Dell, like HP, and like SMCI. Well, enough said. And then you go again, and then you go to the next step, which is the actual hardware providers of the actual memory chips and everything. And but what I am really stunned by, and I have to say, is at how fast all this has happened. In other words, we are literally seeing price increases in memory chips while we're now discussing the deceleration of spending. It adds to the credence of how hard technology compresses cycles, and it makes investing difficult, because if you're going to invest in an endeavor that's going to be obsolete in 2 years, it's a problem. So I'd be very careful about buying hardware and semis expecting them to recover here because of the psychological damage and the Pavlov's dog's imprint in people's brains. They got burned, they got burned, they got burned, and they've been burned for 30 straight days. And I think the appetite won't be there to double down on these stocks at this point. And
yeah. And you had so many names trading at 25 to 30 times revenue, right? Go back to look at the Sun
and we used to
Microsystem
think,
McNeely
David,
comments. Like, I don't know. This is pure gambling. Again, it's absolute gambling, and things can get cheap and get cheaper.
and we used
But
to, David, we used to value stocks expensively about 5 to 10 years ago on 10 times revenue. But you're absolutely right. So we're not overpriced. We're not priced to perfection. We weren't priced to perfection. Now we're maybe priced to perfection. We were overpriced to perfection that was unattainable in the short amount of time frame that these stocks priced in these prospects of
yeah,
future
I
growth.
remember during the dot-com bubble, analysts would value a stock on how many eyes landed on a website like Yahoo, right? Oh, this had 45 billion people look at the page last month. Like, it's it's people looking at a page, there's advertising in there, but when you start to value things and you don't have a profitability on it, that becomes a problem. I saw one company, I won't name the name, came out and said they got an $8 million contract. The stock rallied $800 million. And people are wondering, it gapped up. I shorted it, and then it went straight down, and it's near new lows. And it's like the thing was valued at 30 plus times sales. $8 million contract rallied at 800. That's just in revenue. That's not even earnings. $8 million contract. So there's some crazy stuff happening out there. And it's great news. They got a new $8 million contract, but it's they were losing money right on it, by the way. So back to you.
Just before I get to Brandon, two things to mention for the audience. This will be Tim Cook's last earnings call today. So if you are sentimental in that way, or you're an Apple lover, go ahead and take a listen to that earnings call. The second thing is HIMSS, the telehealth company, is being sued by the FTC and a couple of other governmental entities, accusing it of sharing users' health information with advertisers. That's a big no-no. You're crossing some pretty serious, patient confidentiality lines when you share that type of information, especially with advertisers. So that stock had got beaten up pretty bad yesterday off the back of that news. All right, Brandon, over to you, and then we'll get to Anas.
Yeah, if the him story does come out to be true, that's a tough one. A few of those online, I don't want to call them pill factories, but essentially what they are pill factories is those have gone down. Like over COVID, there were, I think, two big ones that came out and they were handing out Adderall like they were Tic Tacs. And one of the founders of one of those companies ended up getting prosecuted federally. So, that's just a dangerous business. That's a tough one. I actually got pitched to invest in a few of those throughout COVID, like early 2021, 2022, and never made it. It just, not that I didn't like the companies, but it just didn't seem like it was sustainable. So tough to see that. I like Hims as a company, though. I think that they're a great company. But to go, I wanted to talk real quick. Yesterday, I listened into this space, a few other spaces, some that Nikoski was speaking in, et cetera. And like, God bless you all that are capital allocators in public markets, because like I feel for you. Like it's like a 1% or a 2% drop, and you guys are acting like you got into a fight with Tyson. And I don't understand how to like, I emotionally I could not handle that. So I'm just the first one to say it. Emotionally, I couldn't handle it. I like getting into private markets because literally you invest, whether it's 500,000, a million, 2 million, early stage in a company, and you wait 10 years for it. I can sleep well at night because I can wait 10 years. There's events throughout that may be an exit event opportunity, or there's events throughout that may say like, they're raising their next round. Can you help them raise their next round? Can you just reach out to your contacts and whatever? That stuff's fine. Sometimes there may be a down round. Most of the times there's an up round, or the company goes out of business. Like on a day to day, having to worry about a 1.5 or on a 30-day, this 1.5, like I couldn't do it. I just literally, I physically and mentally, I couldn't do it. I'd be throwing up in the toilet every day. So God bless you guys. Now, to get to the story of the situational awareness one, and I think it's being way overblown. Which is typical for the Financial Times to do. I'm sure in a week, Business Insider will have a wrong article out on it on LinkedIn somewhere. And it's just the way that they love, hyping up these situations to make them sound so negative. And I just don't think it is. I think that this is a young dude. He's obviously very smart. He was up a lot, I think, on the trades, and he's it sounds like to me personally saying that this is a dip and it's a great buying opportunity. So he's going back to his investors and saying, you know, I want to buy more. And yeah, he was levered up. I think I saw something that said he was 4x levered up. That happens. That's not an abnormal thing to do. And now he wants to buy a little bit more. Now I think where the danger comes in, and we've talked about this a few times on the show, is he has a large portion in Anthropic. And, I've said it many times. I expect Anthropic and maybe to some extent OpenAI to be severely repriced at some point. It just, again, it is very difficult for them to say they're going to go to the public markets. They're going to IPO at $1 trillion valuation. It's not going to make sense. Anthropic's last round was done at a $965 billion valuation. Now, who's the other company we've been talking about extensively on this show is Moonshot. And that's the one that released Kimmy. Kimmy's last valuation was at $30 billion. And we're talking about, capability wise, they're on a very similar tier. Now, very different business models. One's open weight, one's not, but they're on a very similar tier capability wise as far as Fable and Kimmy 3. So, how do you justify Kimmy having a $30 billion valuation? And I think, there's rumors out that they're now raising it 50 billion just weeks after raising it 30. But then also say that, yeah, it's cool that Anthropic has a $965 billion valuation and wants to IPO at 1 trillion. It's that becomes a very difficult story to tell or a narrative to start, creating there. And you got to do a lot of, hopscotching to get there. So it is what it is. I think that repricing is happening. I think if situational awareness is very deep into Anthropic as far as their portfolio, 20% or so, that becomes a tough situation. But I still think it's a great buying opportunity. And the last thing I'll say here on this, like at least when you're betting in private markets or you're investing in startups, you're investing in the founder. You're investing in the leadership of the team. And I would take, at least in my opinion, I would take that same thought process in the public markets. And so when I see Meta going down and stuff like that, like I just don't understand. To me, I can't fathom it because Mark Zuckerberg is a phenomenal talent. He's a phenomenal CEO, a phenomenal leader. Look at what he's done over the years. And to say, well, they had one quarter where they're investing heavily into the future, and now that has to, oh, well, we're pulling out our money. That's asinine. And so, like, I can't. Again, this is why I'm not I never went to go run a hedge fund or, invest in public markets heavily or use other people's money to invest in public markets. I just couldn't stomach it. I can sleep at night very well investing in startups and going through there. So, but I have that same mindset of you're investing in leadership, you're investing in vision. And I think Zuck even came out yesterday and said something phenomenal where he was like, we have so much compute right now that we're debating whether, leasing some of that out or using it for our great projects. That was forward vision that he had, a year ago, 2 years ago, to see where the puck was heading. And that's what you get out of great leadership. And so, why Meta's down, I don't know. I don't understand it. I understand the free cash flow and everything. But if you're investing in the actual leadership, the team versus where some dot point on a chart is right now, then you're still in on Meta. And that's my
Can I
rant for
interject,
the morning.
Brandon?
Thanks, everybody.
One little point before Anas, just one little point. I agree with you, but when you buy something at 100 and it goes to 700 and you're managing other people's money, you need to manage risk. And you need to also be aware that you're absolutely right. I don't look at when I invest in SpaceX at this point, I'm doing it because I believe in Elon Musk. I've always invested in the crazy ones, as I've always mentioned. The crazy ones are the ones that change the world, so I concur. But there is a difference between seeing massive gains in a market for 4 or 5 years, the last 10 years, and to then realize that something did change, and we have never seen this much issuance of debt or secondaries by a sector that has enough free cash flow to normally finance all of their capex and investments in the past.
Let me say, with respect to um, asset management, um, definitely part of the business is either having or growing a very thick skin, right? Let's go back to Leopold for a second. If Leopold is raising money to meet his cash calls from his prime brokers on his margin, that's very different than I've met my margin calls, but I want to raise more money to double down here, right? We agree on that, Brandon. For purposes of the public's knowledge, right? Leopold through June was up 440%. Michael Burry on an LTM basis is negative 5.5%. So, and listen,
Okay, yeah, you know what? Just stop right there, real
yeah,
quick. This is what I'm talking. I love that you said that because I think it was Nikoski that just said Michael Burry's ripping, and maybe he is. Maybe he's making some great calls. I don't know. I don't follow Burry that much, but just to imagine imagine what's being said right there. This young dude is up 439 fucking percent, and we're accosting him for that because he's bringing in more capital, and mainstream media is accosting him for that and making up all these different narratives and stories. But Michael Burry's being, put up on some pedestal, and he's down all this. I mean, just come on, man. This is why,
Very,
sometimes
yeah.
the narrative gets out of the way.
Keep in mind, everyone makes money in a parabolic move. Not everyone holds on to those gains on the other side. So you can be a genius for 2 months, but when the smoke clears and you're down 50%, you're like your Sharpe ratio. If you're taking investors and you say, "Look, I'm up 400, now I'm up 100," right? Like it
But
does
he's up
matter to investors.
2,200% over. But he's up 22% over 2,200% over what, a 2 year period since
Yeah,
2024. So
and
I
you
mean,
haven't
the
had a bear
conversation
market
we
yet.
got is a little bit different than just saying he got lucky on a 1 month trade.
If you it is the trend in tech has been up for 2 years. Let's see what he does through a bear market, and if he's still buying the same things and holds on to CoreWeave and it's down another 70%, and he's holding it, like you have to protect positions on the way down. We haven't had to protect positions on the way down for almost 2 years. Like, look at 22. Energy was up 85%. The market was down 20, almost 25%. That's a huge, you are having the biggest sector deviations going back to March of 2000 in terms of relative performance. I can see how everyone's positioned. It's when you look at relative strength and you see that energy is at 3% of the market. SpaceX has lost more market cap than half of the entire energy sector. The entire energy sector. Like, that's a big freaking drawdown. But yet we're all
Okay,
bullish,
but do
right?
you believe, David Nikoski, do you believe that Elon will be directionally right over the next 10 years? That's what I say. That's what I believe. So it doesn't matter if it dips down tomorrow 15% more, or if it, goes parabolic 100% more tomorrow. That makes no difference to me because I'm thinking about the next 10
Oh, it
years.
depends on your time horizon.
Yeah,
But it
and a
depends
lot of
on.
people in 70, a lot of people in 73, 74 was thinking about the 10 years when they were buying, Kodak, Polaroid. Things change.
But it
And
but it
in
depends on your
any
time
stock that
horizon.
has ever led, never in history did it lead for the next 10 years, right? You can look at Microsoft now, but Microsoft did not lead, post the 2000 bubble in terms of relative performance, right? Energy far outperformed the market. The S&P, think about it this way, without some of these mega caps leading, like the market can go up, but you're underperforming. I just gave you the dynamics of Meta and Microsoft. Huge underperformers, but yet everyone wants to pick the bottom. But you have to manage, you can't manage in the past, right? If I hear someone bring up Bitcoin as the best performing asset, I don't manage money 10 years ago, right? And that's the thing. I liked Bitcoin. I turned negative on Bitcoin. I rotated, right? I owned Bitcoin. Like I'm not a basher of anyone in their asset class. I'm following relative strength. Relative strength is telling me what's outperforming now and what's underperforming. And that is, you're managing for today. You don't manage, oh gee, SpaceX, like Kathy Woods was buying SpaceX at what, 220. She has burnt more capital in this market and gets more airtime than anyone.
Look at the
I think
overall
she bought the
performance of ARK.
crashes, but that could be wrong.
Look at the overall performance of ARK Fund. I mean, everybody uses this. I don't know. Again, God bless you all, because you all do, you manage all of this on like a day to day or a week to week or a month to month basis. And, um, I pray for all of you when I go to bed at night, because I just couldn't
You're a
do
good
it.
man, Brandon, and this is further reason we've solidified today for you why you should not be in public markets. I'm happy you showed up. You're going to walk away and say, I have definitely made the right choice, 100%. Justin, go ahead. By the way, we went on so long that we tired Anas out, and we're not getting an energy update today. He left, so there we go. But
We
go
should
ahead,
just
Justin.
close the space right now. With Honest, what are we? No, just kidding.
Yeah. Hey, by the way, the ARK fund was at a relative strength high at 425. It's now at 101. She's lost 75% versus the S&P since the peak in January of 21.
How long
75%.
does
So
ARK Fund run?
that's a huge drawdown. Like you have not made money in there. If you bought from that high, you need a 300% rally now to get anyone to make money from that
But
21 high.
Nikoski, in what time frame? That's what I'm trying to
well, that's
explain to you.
that's
21.
In
my
what
question though,
time
I gave you
frame?
the
because
time frame.
now obviously live. Anybody who's done live before, like live spaces, you have to create examples and create arguments on the fly. It's very very difficult to do. But I did want to ask: is the Kodak comparison to SpaceX, like to Brandon's point? I agree. Like it's going to be volatile maybe in the immediate future, but I think in the 10 years it's going to go parabolic. Is the Kodak example just one that basically the comparison is people invested and it went down, or are you making the comparison that like SpaceX best days were behind it? I'm actually very interested to know this. One of the things I really appreciate for everyone listening about David is David's a highly, highly intelligent dude that sees the same stocks, SpaceX and Tesla specifically, from a totally different light than I do. So pushing and asking people like David questions like this is probably how I'm going to make and protect a lot of investments. So I'm really curious to know your view on that.
No, timing is everything. I can't tell you where it's going to be in 10 years. But if you bought it at 220 and you're at 112, imagine you're a portfolio manager and you have a 50% drawdown. You say, my time horizon is long. You're going to lose assets. Trust me, you will lose. You're down 50% and the market is literally flat. Like I'll buy it when it turns. I don't need to, prognosticate. Oh, I think this is going to be a great buy. Tesla, as much as I'm going to call it, it's a cult stock. You know, like if you're sitting in it and saying this is long term, right? Let me just tell you, from its peak, it is down almost 60% versus the S&P since 1029 of 21. 60% underperformance. You can love the stock. I don't love stocks. I just go where the money's going. It's money flows. And if you're down 60%, you could have been in the S&P and be up 60%. I don't know of anyone over a 5-year period that likes to be down 60%. Do you?
Yeah, so
No,
I'll agree.
absolutely.
Hey,
So what's
hold on,
David,
Eric.
what's your
Hold on.
strategy because it sounds like you do think there is potential. and correct me if I'm wrong, obviously, but it sounds like you do think there is potential where SpaceX. You maybe not don't view the Optimus as being anything worth its salt at Tesla. I think it's going to go crazy, but SpaceX specifically, what's your strategy if that starts to go parabolic? Like, how do you are you? Is that something
I
you're
look for an
watching?
inflection. I look for a bullish inflection. Right now at SpaceX, like if you came to me and said, "Hey, look at this chart. It's got, a month and a half of data." Like it doesn't do any good to me. Like I don't do IPOs, right? I can't chart an IPO, but I look at
Yeah.
relative
But wait
strength.
a
And
minute,
I don't like
David.
a 50% drawdown in a month and a half
David,
either.
charts are good and they work, and I'm all for them. But let's be honest here. What we're talking about is what is your time frame for investing, which should completely dictate your investment strategy. I mean, my largest argument, since
Okay.
I do everything. I invest long term for my client book. I invest in trading strategies for my more aggressive clients, and then I go into and I have day trading strategies also. So it all depends. But it all
Yes.
depends on what
But
that is.
it
But let's be honest. I'm going to be honest. I bought some of the SpaceX IPO after on that first day, and waited and waited and waited and waited and waited, and I'm still waiting. And I think that you're going to find an entry point here, probably around the $100 range. I don't know why I feel that way, but for whatever reason, markets love round numbers. And we've gotten exhaustively. We have sold this area of tech in an excessive way in the short run. So we're going to have a hell of a bounce. And what I'm looking at is what rallies at the end of the day when everything else is going down. That tells me that there are names already in my quiver that I'm looking to buy, including the ones that are getting hit at today's open. I've already made a decision to go back into Netflix after owning that for a tremendous amount of years. And I'm considering the same thing with Meta because the damage now creates a better place where you could actually extrapolate how much of the future has been priced in. But Brandon, you're always investing in long term when you're in private markets. Your time horizon has to be over 5 years on average, unless we have such acceleration in cycles that private markets start to actually have to react more quickly. And you look at the debacle of the software investments that all went bad here in the last 2 years. So time horizon should dictate what you're going to do and how you're going to do it. It's so important.
okay. Well, I have long term if something breaking a long-term downtrend, like I've been in the engineering and construction stock since June, July of 22. They have far outperformed, like like significantly outperformed the market, right? So you stick with things until they break. And just to give you an idea, in the last 5 years, STRL is up 1,252% above the S&P 500, right? That was the right call. But I don't have a chart for SpaceX. I'm going to wait until it produces a chart for me, right? I'm not going to go look at a month and a half data. I'm fine to miss it. There's other things to do. That's what I'm saying. Like, you don't have to fall in love with the stock and say this is going to go this in 10 years, right? But if I can get, 1,252% of performance over 5 years in sterling, and there's 10 other ones in there that I could point to that have the same performance. Like,
Okay.
you know
So
what? There's everything is an alternative, right? I don't have to own CoreWeave. You know, I don't. You can love the stock, you can love Iron, you can love anything you want, but my clients need to know when to shift. And the longer the trend that's being broken, the more important it is. And the example I just gave you, I have, charts going back to 1969. Okay. If you break a 20-year downtrend, that is going to outperform. That's what engineering and construction did. I think the data speaks for itself on the performance.
Yeah, but these are two different
yes,
things here.
I'm gonna say,
One is like
hold on,
Warren
Eric,
Buffett,
real
where
quick,
you invest in a
Eric.
business for the long term, and then you have what you're saying,
Am I? Am I?
David,
Am
where you
I?
can rotate just because it makes more sense and it gives more returns in the short term and medium term. They're both valid. You know, they're both valid. They're just different ways. Warren Buffett is more like a private equity guy where he'll invest for the long term because he says that's a solid business over the next 5, 10, 20 years. And it's a very valid way of investing. Just the returns will be probably a bit lower than somebody rotating like you and I do. Yeah, every whenever we think that the market is time to rotate, and there's just two different philosophies of investing. And Warren Buffett is more closer to the private equity side, but they're both very valid ways of managing money. Go ahead, Eladio.
Oh wait, can anybody hear
Yeah,
me?
Brendan, go
Am
ahead.
I
Yeah, we
am
can
I
hear you.
Go
I
talking?
can
ahead.
hear you.
I hear me.
Go
Oh,
ahead.
okay, thanks. So when we talk about outperforming, like maybe it's hard to do an apples to apples comparison here, but I've like if we look at the TVPI of like my fund, for example, like we it's hard to even compare here of what is outperforming. I mean, skyrocketing past that. And so and maybe that's not DPI yet, and that's simply because of the time frame, but you can extrapolate from looking at the TVPI versus S&P or whatever anybody else wants to look at here. And I can promise, and I'll send these numbers to anybody that wants to verify that we've strongly outperformed these markets. And so when I talk about time, and that's over 4.5, 5 year period now. And so when I talk about these being willing or having the conviction to hold longer, that's what it is. And maybe that's the difference between public and private markets, whatever people want to talk about, I don't care. But if like I just can't imagine, I can't fathom right now in any type of a market saying I want to bet against a Mark Zuckerberg. I want to bet against an Elon Musk. I want to bet against a Travis Kalanick. Like when you look at these founders and when you look at what they've done in the past and what they're doing now, you just have to have some type of belief, and that belief is not, I'm not throwing this out here pissing in the wind. It's belief off of my own performance in the past that they're going to continue to outperform. And so maybe this is just a real difference between public and private markets. I don't know. Again, God bless you all, but I can sleep
Well,
well at night and knowing
it's
that my funds are doing
it's
well.
kind of the difference between performance investing and breed investing. Like, Nikoski's talking about performance. Like, I got to see history. I got to see the data. I don't give one crap about who the founder is. I don't care what he ate for breakfast. I don't care about his previous success. I mean, that's not a. I'm sure he does care about that, but this is just a very basic breakdown. And then there's breed investing. I'm just making this up. It's not like a known term, and that's more like look at the founder themselves, look at the vision, look at the problems they're solving, and their likelihood of solving those problems. It's kind of like there are two different visions here, both of which can make money. But if I'm wrong, push back.
That's why you can do both at the same time. And that's what I do. You time yourself on those companies or those, let's say SpaceX, for example. Yeah, Elon Musk, just to give a concrete example. Then you will time yourself when it's the time for entry in that sector and for that stock and get in and then leave it to run. Because really that's the reason I talk about timing all the time, and every 6 months or 12 months, then I say when it's time for when the winds are changing direction, yeah. It can be a super great stock for the long term, but when the winds change direction, I get out. And then when the winds come back in the sales, then get in again onto that great stock. And then you make amazing performance with a solid approach because you don't get burnt. And that's very important. So combine technicals and fundamentals. Back to you guys.
Brandon, I'll continue to take your gratis prayers. Please continue to pray for me. I appreciate them. They're working. All right, folks, I'm going to go ahead and hold it there. We'll have Apple to talk about tomorrow. Also, Amazon reporting after hours. Futures are green. We'll see if it sticks throughout the day, especially since, I think Warsh's sentiment did come in loud and clear yesterday. And in addition, the earnings from Meta and Microsoft and some others are giving support to the broad theses that we've been discussing here. We'll catch up again tomorrow at 8 a.m. Thank you, everybody, for a great show today. And have a great day in the markets. Take care.